Hi everyone, hope you are doing good as always. Today, the topic we have to discuss is mutual funds. What are they and what are they used for? They are the investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, and other securities. When an investor buy a share in a mutual fund, they are essentially buying a portion of a portfolio and its potential returns. The share price of a mutual fund is determined by the net asset value NAV of the fund. NAV we'll discuss later. What is NAV? And NAV actually, in short, what we say is the total value of the securities held in the portfolio less after subtracting any liabilities and then divided by the total number of shares outstanding. The NAV is calculated at each end of the trading day based on the closing price of the security held in the portfolio. Where an investor buys or sells shares in mutual funds, they do so at a NAV price. Whatever the NAV price is determined at the end of the day, the buyer or seller is bound to trade on that. However, some mutual funds may also charge a sales load or other fee, which can affect the purchase or redemption price of the shares. So, this is a little introduction of mutual fund. And now we'll discuss the types. The first one is the open ended mutual fund. And here the price is determined on the NAV as discussed before. There is another type of mutual fund actually that is closed ended mutual funds, and their price is not determined on NAV basis. Rather, they are determined on the stock exchange, just like the other stocks, on demand and supply basis, on the market forces. So, before going through the example, let us discuss the key features of the open-ended funds. The first one is the buying and selling of share is unlimited. Unlike the normal companies, the standard companies that are bound to issue shares according to their articles of association restriction, uh, here there is no restriction at all, and buying and selling is done directly through the company. There is no stock market involved. And also, worth noting is their price determination is on the basis of net asset value NAV, whereas the other type we'll discuss later, the closed-ended mutual funds, their price determination is through the stock market on the basis of the market forces, demand and supply. Also, their share issue is restricted as just like the normal standard company procedure. They have the IPO and then FPO follow-up, a public offering, and their stocks then get float on the stock market just like the new normal companies do have this practice. So let us understand this NAV concept, NAV pricing concept through an example. NAV is actually calculated through a formula that is assets less liability divided by total number of shares of the mutual fund company. And it is calculated on daily basis. At the end of the trading day, it is usually calculated before a little cut off time so the transaction can take place. So whatever the value is at the moment, the trade takes place on that value, on that price. So here we can understand this through an example that NAV of a mutual fund company is $20 per share, and an investor buys 100 shares. That means the price for that day will be, his investment total will be $2,000. And after a week, if the NAV of that mutual fund company increases to $22, and that will create its investment value to that will elevate its investment value to $2,200. So that will result in a profit, of course. So, some more characteristics of open-ended funds is liquidity. Liquidity is high in this case because You can directly buy or sell your mutual funds uh, s- shareholding from the company itself rather than going to stock exchange. So whatever there will be a prevailing net asset value at that moment, that will be the price of your shares. So it will be easily converted to cash. Continuous offering means open-ended funds do not have a fixed number of shares available for purchase. The fund company continuously offers new shares to investors and will buy back shares from investors who wish to sell. The pricing, as we have discussed before, the NAV is the source of determination of the price. Diversification is mutual fund company usually have the expertise regarding the market, and they have the diversified portfolio to offer to their investors. Uh, and the investors' security risk is also mitigated through that process. Professional management. Open-ended mutual funds are managed by professional portfolio managers who have the expertise and resources to analyze securities and make investment decisions on the behalf of the fund's shareholders. Mutual funds usually charge fee to manage the expenses and managing the mutual funds as a whole. And this fee can include management fee, administration expenses, and other costs. Overall, open-ended mutual funds offer investors a convenient and flexible way to invest in a diversified portfolio of securities managed by professional money managers with the ability to buy or sell shares at any time. So let's talk about close-ended mutual funds. Close-ended mutual funds, unlike open-ended mutual funds, they have a limited number of shares, and they are issued through IPO, initial public offering, and then the follow-up public offering. Just like the normal company, how the article of association permits them to issue the limited amount of shares, they should be stringent upon that. So that is one of the big difference between these two types of funds. Let us understand through an example. Another thing to talk about is they are listed on the stock exchange, uh, and their price determination is from the demand and supply, as what the stock exchange process is usually all about. Let us understand the close-ended mutual funds through an example. The BlackRock Science and Technology Trust is a mutual fund company that has a business model of investing usually into the technology related and innovation related companies. The fund issued a fixed number of shares through an IPO, initial public offering, in 2014, and also their net asset value is also given 1.3 billion, but it will not be relevant here because as we have discussed before, the close ended funds are, and their prices are usually determined on the stock exchange through demand and supply forces. So the investors who wish to invest in the BlackRock Science and Technology Trust must purchase shares through a broker, just like any other stock. They can trade these shares on the stock exchange, and the price of shares is determined by supply and demand in the market. Unlike open-ended mutual funds, there is no direct relationship between the price of the shares and the net asset value of the fund, and the price fluctuate significantly based on the market conditions and the investor sentiment. Characteristics of a closed-ended mutual funds, unlike open-ended, they have a fixed capital and fixed number of shares that they are obliged to issue. So they cannot issue new shares to raise more money. Listed on the stock exchange, as mentioned before, they are on the stock exchange. So their the share price is determined through supply and demand in the market. Limited liquidity. The limited number of shares and the fact that they are not redeemable on demand means that closed-ended funds have a limited amount of liquidity. Unlike open-ended, they can be they can be redeemed, and they can be sold back to to the company at any time on the NAV value. Uh, the close-ended have a limited liquidity because it's difficult for an investor to sell their shares on the stock exchange relatively. So, a professional management is close-ended. Mutual funds are managed by the professional fund managers who invest the capital raised in the portfolio of securities according to the fund's investment objective. Mutual funds, as they have an inherent feature of diversification, they have a huge access to different asset classes. So diversification is there. Let's talk about expense ratio. Expense ratio of a mutual fund represents the total annual cost of managing and operating the fund. And it is expressed as a percentage of fund's total assets. The expenses may include management fee, administration costs, marketing expenses, and other operational expenses. In general, closed-ended mutual funds tend to have higher expense ratio than open-ended mutual funds. This is because closed-ended mutual funds have a fixed number of shares outstanding and are traded on the exchanges like stocks, while open-ended can issue new shares or redeem existing shares to meet investor demand. As a result, closed-ended funds typically have higher administrative and marketing expenses as they require ongoing efforts to promote the fund and attract new investors. In addition to that, closed-ended funds often have lower levels of liquidity than open-ended funds, which means that it may be more difficult for investors to buy and sell shares. It can result in higher trading costs for investors, which may also contribute to the higher expense ratios of the closed-ended funds. It is worth noting that higher expense ratio of a closed-ended fund does not necessarily means that it's a poor investment. Investors should consider the fund's investment strategy, historical performance, and other factors before making an investment decision. So that's it. That was the discussion regarding mutual funds and the two main types. Inshallah, we'll meet you in some other lecture and another topic, and in the continuity of this investment analysis and portfolio management. Till then, we'll meet you. Have a nice time. Bye.